Welcome back to Money Dynamo. Today, we're diving into a critical question. What happens to China if Donald Trump wins the 2024 election? Trump made headlines with his tough stance on China, and the impact on the global economy was profound. But, with tensions already high under Biden, how would another Trump term change the game? When Donald Trump took office, he dramatically shifted U.S. policy towards China. He imposed tariffs that marked one of the most significant tax increases for Americans in peacetime. China, once the U.S.'s top trading partner, was recast as a military and economic adversary. So, if Trump returns to the White House, will things get even worse? Or is Biden's current approach just as problematic? Surprisingly, Biden hasn't eased tensions. In fact, he's doubled down. Not only has he maintained Trump's tariffs, but he's also introduced new measures to stifle China's technological advances. Remember the Inflation Reduction Act and the CHIPS Act? These are Biden's tools to cripple China's tech sector in favor of American interests. Once upon a time, Western factories flocked to China for its cheap labor, while China benefited from jobs and industrial growth. But the landscape has shifted. Chinese factories, which once produced low-cost goods, have evolved. Now, they're designing and manufacturing high-value products like electric cars, solar panels, and drones, industries where the West doesn't have a historical advantage. Consider the electric vehicle (EV) market. Historically, Europe and the US led in combustion engine production. But with the rise of EVs, China has taken the lead, challenging Western dominance. Even more concerning is China's reputation for intellectual property theft. From cars to drones, Chinese companies are notorious for copying Western designs, often with little to no modifications. All these factors contribute to the ongoing U.S. China trade war. But do we really understand what's driving this conflict? What are the exact mechanisms at play? And most importantly, who's winning? Today, we'll break it down. One of the most visible victims of this trade war is Hong Kong. The city's economy has contracted in 3 of the last 5 years, and its stock market has plunged nearly 50% since 2018. But could this crisis actually present a golden opportunity for investors? To simplify, the U.S. strategy revolves around 2 main pillars. First, cripple China's production capabilities, and second, boost domestic manufacturing. Let's start with the first. How does the U.S. plan to attack China's factories? One key tactic is to cut off China's access to advanced microchips, which are as essential to the 21st century as oil was in the 20th. Without these chips, developing next-gen military equipment or advanced AI becomes a massive challenge for China. Biden's administration has imposed strict restrictions on chip exports to China, especially those with potential military applications. So, how has China responded to these new restrictions? By ramping up domestic chip production. Since the sanctions, China's imports of chip-making machinery have surged by 50%. But there's a catch: these machines aren't the latest models. While China may eventually catch up, for now, they're stuck with older technology. The second part of the U.S. strategy is to revive its own manufacturing sector. Biden has poured billions into bringing factories back to America. Since 2007, investment in U.S. manufacturing infrastructure has tripled, thanks to Biden's policies. However, there's a downside. While these subsidies might boost domestic production, they could also lead to inefficiencies and wasted resources. Take Biden's $7.5 billion plan for EV charging stations, for example. In 2 years, it's only produced 7 stations nationwide, a clear sign that throwing money at the problem isn't always the solution. As China faces increasing pressure from U.S. tariffs and restrictions, it's been quick to adapt, finding alternative ways to get its products into the American market. One significant strategy is routing exports through Mexico. Since Biden's measures took effect, China's exports to Mexico have surged by 50%, effectively using Mexico as a backdoor to the U.S. market. This not only helps Chinese companies avoid tariffs but also takes advantage of the U.S. Mexico-Canada Agreement, USMCA, which allows goods manufactured in Mexico to enter the U.S. with minimal duties. But China isn't just exporting more goods to Mexico, it's also setting up shop there. Chinese manufacturers are increasingly establishing factories in Mexico to produce goods labeled as "Made in Mexico," which can then be exported to the U.S. under the trade agreement. This trend, known as nearshoring, not only helps Chinese companies evade tariffs but also reduces shipping times and costs, making their products even more competitive in the U.S. market. The U.S. government is aware of this workaround, and there's been growing pressure on Washington to address it. Some policymakers are calling for stricter enforcement of the rules of origin in the USMCA to ensure that goods coming from Mexico truly originate there. Others suggest renegotiating aspects of the agreement to close these loopholes. However, these measures could strain relations with Mexico, a critical ally in the region, making it a delicate balancing act for U.S. officials. If the U.S. pushes too hard on this issue, it could risk damaging its relationship with Mexico. The Mexican government, for its part, sees these Chinese investments as a boon for its economy, creating jobs and boosting local industries. This could lead to a situation where Mexico resists U.S. pressure, creating tension between the two countries. The U.S. must navigate this carefully, balancing its desire to limit Chinese economic influence with the need to maintain strong ties with its southern neighbor. China's strategic move into Mexico is part of a broader effort to increase its influence across Latin America. Through investments in infrastructure, energy, and telecommunications, China has been steadily expanding its footprint in the region. This growing presence could challenge U.S. dominance in its own hemisphere, potentially reshaping the geopolitical landscape of the Americas. The U.S. may need to reconsider its approach to the region, focusing not just on trade but also on diplomacy and investment to counter China's rising influence. The shift in Chinese manufacturing to Mexico also highlights the complexities of global supply chains. As companies look to diversify their supply chains and reduce reliance on China, Mexico offers an attractive alternative. This trend could accelerate as businesses seek to mitigate risks associated with geopolitical tensions and potential future tariffs. However, this shift also raises questions about the long-term sustainability of global supply chains and the potential for new trade conflicts as countries compete for manufacturing dominance. In conclusion, the U.S. China trade war is far from over, and we're only beginning to see its full impact. The U.S. is doubling down on industrial policy, rejecting free trade, and imposing sanctions at levels we never imagined a decade ago. With foreign investment in China turning negative for the first time since the late 20th century, the future remains uncertain. Now, it's your turn. How do you think this conflict will evolve? Should Western countries accept subsidized Chinese goods, or are tariffs and restrictions the way to go? Let us know your thoughts in the comments. And don't forget to subscribe to Money Dynamo for more in-depth analyses every week. If you enjoyed this video, give it a like, and we'll see you in the next one.